Good morning, everybody. Welcome to today's live event. My name is Andrew Wilkinson, Director of Trading Education, and also on the camera here, we have the star of the show, Jose Torres, who's Interactive Brokers Senior Economist. How are you, Jose?
Good morning, Andrew. Doing well. We're seeing the markets really respond very positively before the numbers are even out. So looking forward to a little preview with you all, as well as a reaction once the numbers are released at 8:30 a.m. Of course, we have a lot of data on deck today, but the number one publication is going to be non-farm payrolls.
And it's not just the recent month, but it's the last 2 months, right? So just to remind everybody, it might seem like a lifetime ago, but the government reopened and decided to put out, combine the October and November jobs reports to come out today. And of course, a week after the FOMC has already made its decision to cut interest rates. So what's the fascination with this, with the payroll report today, Jose?
Well, the reason why the Fed has cut three consecutive times in the last three meetings has been labor market fragility. So Wall Street is really looking forward to the last jobs report of 2025 to really gauge the path ahead for the Fed. Because if the labor market is a lot stronger, and in yesterday's commentary, the number that I pointed to as being too hot would be something north of 80 and something too cold south of zero, those numbers would essentially, on the higher side, on the 80,000 side, if we were above 80,000 today, that can really quell a lot of the monetary policy enthusiasm, easing enthusiasm, that is, that's been baked into the market. We know that AI trade has been fading, so investors have been positioning in the more cyclically oriented, rate sensitive areas of the market. Overall benchmarks that have those characteristics, higher tendencies, are the Dow Jones Industrial and the Russell 2000. We've been seeing the Russell 2000 make records a few times in the past few sessions, not yesterday. But the S&P 500 and the NASDAQ, they're AI heavy, tech heavy. They haven't really seen that enthusiasm. So really, the way I'm seeing it, the broadening of the rally and the increased participation prospects can really come from a dynamic where the economy is continuing to grow while allowing a few rate cuts here and there. Otherwise, if the AI trade fades and you don't have the rate cuts, then it's going to be hard for the Russell and the Dow to participate, and then there's risks to the downside.
And the audience, please do send us questions, direct them to us on our X channel, and we'll get to those throughout the remainder of the program. You may want to wait until after the data. Jose, set us up. What was the labor? What's the latest snapshot of the labor market?
Sure.
And then tell us about what's expected today. I think it's very interesting because we've got the two back-to-back reports being released together. But there's something that I would look for, which is, we tend to look at the average gain, say, over the last 3 months. I'm interested in what that trend turns out to be as we head to the end of the year. And what it tells us about the health of the market, kind of as a snapshot at the end of the year.
Absolutely. So we're expecting 40,000 job additions in the month of November. We're expecting the unemployment rate to remain unchanged at 4.4%. To give you a gauge, I don't want to talk to you a little bit about the 3-month moving average on the BLS statistics, because since we don't have November or October, these two numbers that come out can heavily affect that average. Of course, it'll be 2 out of 3. So what I'm going to show you here is the ADP numbers, which have really been uninterrupted. And by the way, we just got an 8:15 a.m. reading on ADP. We'll go back to that in a second. But we have here essentially, you lost jobs in June, you lost jobs in August, you lost jobs in September, and you lost jobs in November. November was the sharpest decline in roughly 3 years or so. And the 3-month moving average actually went negative 5,000 for the first time since the pandemic era, when we had those, consecutive job losses. So here's the worry here, that there's a deceleration in job growth and that there is a tendency for when there's a few layoffs, for those to snowball, because the traditional economic chain of things is that a few people lose their jobs, they cut their spending, that begins to subdue revenues at their vendors and the places that they buy from, and then they start trimming labor, and it goes on and on. So that's really the worry, and that's why the Fed has been cutting, albeit there's been heavy disagreement on the committee. And let me tell you why there's been, let me show you another chart as to why there's been so much disagreement across the committee. And Andrew, what's happening is that inflation has been rising, and it's been above target if you include December for 58 months. And let me show you this chart here. So, we essentially crept up, and this is the PCE price index, the Fed's preferred inflation gauge year over year, not the core, but the overall core is very similar. And what you see here is that since March of 2021, we've crept above the 2% target. We got close in September of 2024. That was the month that the Fed dished out the half a point cut. And then we also got close in April of this year at 2.3% and at 2.1%. But now December's looking like it's going to be 2.9%, as well as the October and November months at around 2.8. So really 58 consecutive months and counting of the Fed essentially tolerating above target inflation. And the reason why, of course, is the chart that we showed previously, that once you have a labor market issue, you'd rather have an inflation issue than a labor market issue. And it really informs my view on how the dual mandate has shifted from not necessarily from less of a 50-50 framework on inflation and employment to more of a 70-30, where the Fed is really trying, and not just the Fed, central banks around the world, including the Bank of England, are essentially defending prosperity, defending the expansion, defending the good times, and allowing inflation to run at around 3%.
And if you add the unemployment rate and the inflation rate, the official CPI together, you get the misery index, right? So when I last looked at that last week, I think that's running at about 7.3%, which is the highest since August 2023. So we're hopefully not going to see an uptick in the unemployment rate today, which would make that even worse, right?
Yes, and some good news. Let's report out on the ADP weekly indicators. So in response to the longest government shutdown in history, ADP said, well, let's start releasing a weekly indicator of what's been the average hiring performance over the last 4 weeks. And we've got an acceleration, folks. We've got the average picked up from almost 5,000 during last Tuesday's report, now up to 16,000 for this report. So that's a little bit of an acceleration, and it really supports the potential for an economic pickup into next year. The arguments there are that consumer spending remains strong, unemployment is low, and then monetary policy easing. You're going to probably get at least a little bit of it. If you don't get rate cuts, you're going to get some help on the balance sheet with the Fed going out there and buying T-bills amounting to roughly $40 billion a month or so for now. And then, of course, you have fiscal stimulus, the taxation packages passed in 2025 that are expected to deliver stronger tailwinds next year, the 100% depreciation write-offs in the first year, milder regulations, so on and so forth. But a pickup in the unemployment rate, of course, and labor market fragility. So a number, let's say, below zero, where we have job losses in November. Let's just say we had job losses in November and October, rates would plunge and the Fed's cutting expectations would increase significantly, but that wouldn't be an environment conducive for corporate earnings expansion. So that could result in a sell-off. Likewise, if you go above 80, that'll subdue Fed easing expectations, and then start to incrementally place the Fed in a group of central banks that are now talking that the next move is going to be higher. On that list is the Bank of Australia, the Bank of Canada, the European Central Bank. So that would really compel a repricing across assets if for whatever reason, folks thought that the next move from the Fed would be a hike. We're not close to that point yet, though.
We're getting a couple of questions in. There's a particularly good set of questions for after the numbers, so we'll come to those later on. And at Scotch and Stocks, are you the voice? And I presume you're asking me whether I'm the guy who says, order filled. Yes. Here's the response.
Connection lost.
Jose, obviously the most important report today is the labour market data, but there's more data as well. We've got another two reports coming out at 8:30 at the same time. The screens are going to be busy, but we've got retail sales and we've got housing data as well. Tell us about the relative importance of both of those data sets coming there.
Not that important at this juncture. The real estate market is starting to improve a little bit. You're starting to see that even though long end rates aren't coming down in the treasury complex that much, you're seeing that the spreads on mortgages are narrowing. So that's been a good relationship. So where if you'd expect the 30-year fixed with a 10-year of 4.17, if you'd expect the 30-year fixed to be at around 6.667, it's more like 6.364. So that's been alleviating a little bit of the concerns in the real estate market. However, the space is still facing weak transaction volumes and soft construction activity. Yesterday's home builder sentiment did provide, however, the third consecutive improvement in a row, albeit it was only 39, so still ways below the positive negative threshold of 50. Retail sales, unless you get a big miss, it's probably not going to move the market much. This is a stale number. Retail sales is stale. This is an October number. So it's not going to even tell us what happened during the Black Friday statistics, which we know from the credit card companies and from other surveys that it was particularly strong. So no one's really going to pay attention to those two numbers. However, Thursday, you have a consumer price index report. And it's pivotal, but not as pivotal as today, because today's report has more volatility when you look at the historical trends. So we look at the consensus estimate on non-farm payrolls. The number that actually comes out is usually, has a tendency to be wide ranging, can be well above expectations, well below. Whereas the CPI, it tends to be relatively aligned with what the street is expecting. So your beats aren't that significant and neither are your misses. But the key with CPI is that you're getting close to that 3% level at 2.9. So psychologically, a 3 handle and a 2 handle is a significant point to consider, because when you're in a 3 handle and when you're a 2 handle, even though the difference is only 0.1 and a lot less, if you start talking about rounding, that can really inform psychologies on, is the next step 3.5 or is the next step 2.5? Finally, we've seen that the odds, before the number comes out, we've seen that the odds between who's going to be the next Fed chair have shifted significantly, folks. Kevin Warsh is now in the lead at 45%. Kevin Hassett is at 41%. Waller is up to 9%, and Bessent is at 2%. Really, between Warsh and Hassett could be surprises. The two Kevins. What's really been weighing on Kevin Hassett's odds is that he keeps repeating that the central bank should be apolitical and shouldn't really be influenced that heavily by the White House. He keeps repeating that. There's also concerns that folks in Washington think that he's too close to the president to be Fed chair, and that's really helped Kevin Warsh's odds rise significantly, folks. He was at just 9% on December 9th. Today, he is at 45%. And now let's get ready for the numbers. Drum roll.
And Jose, you're taking these directly from bls.gov, I take it?
Yes.
Probably got television screens all around you as well, haven't you?
Yes. Got a trading view connected to Interactive Brokers. We have Bureau of Labor Statistics. And we will be getting the number shortly, folks. And it is 8:30. Okay, so we got a soft beat at 64,000. The unemployment rate, however, did increase to 4.6%. Equities are maintaining their move higher. Rates are coming down. The 2-year yield is at 3.46. It's very, very low level. It's been fighting with the 350 level. The 10-year is looking to break 4.15. Futures are up roughly 73 bips. Let's get into some sector information.
I think the big jump out there is the increase in the unemployment rate to 4.6%. So that add that to the 3% inflation, you got a very uncomfortable misery index of 7.6%.
Yeah, Andrew, and when you look at under the hood, the performance was also particularly miserable, because look at who's really driving your job growth. It's private education and health services. That's not a cyclical area at all. That's driven a lot by fiscal spending and is not indicative of a strong economy. But outside of that, you had a meaningful gain in construction of 28,000. You had peanuts in professional business services of 12, 6 in retail trade, and 3 in other services. But then the list of sectors that lost jobs, 1, 2, 3, 4, 5, 6, 7, 8, that's particularly worrisome because it's broad. Government, we'd expect down 5, leisure and hospitality down 12, finance down 2, information down 4, transportation, warehousing down almost 18, wholesale down 2.2, manufacturing down 5, and mining down 4.
Interesting that manufacturing continues to not improve. Down 5,000.
And just to go to see, it's probably the highest since 2021 here on the unemployment rate. This hasn't been updated yet, but the 4.6% would be the highest since September 2021. So that's a 4-year high on unemployment.
A 4-year high in the unemployment rate.
Let's take a look at what's happening with Fed rate cut odds, and then we'll look at some other data points as well.
I'd also be interested to see this is the November payroll report, just to remind the audience that we're looking at. We haven't looked at the October report yet, which is somewhere. It's all data establishment data.
Yeah, so you're getting a lift here in not too much of a lift, but you're getting 20 odds of last trade went through 24% of the Fed's lowering in January. And I'm going to take a break from the screen share and analyze some reports, and then I'll come back to you with commentary.
So the October change in non-farm payrolls was said to be minus 105,000, Jose. That's a huge drop. So it pretty much wipes out everything, the 108,000 from September. So that would give us a net 3-month gain of 67,000, which would be 22,000 average over 3 months. That's pretty shoddy for the US economy. And manufacturing has lost employees in the last 3 months for a net loss of 19,000, and a year ago the net gain was 20,000.
Yeah, and a pivotal number here also that we haven't reported on, and we've just been reporting on the November numbers. Now we're heading into October. October was a lot worse than November. October featured a loss of 105,000 jobs, which I was paying attention to. You, Andrew, I think you alluded to that. So that would really bring our 3-month average to, 108, let's see, roughly 20,000 or so. September was 108. October was minus 105, and then November was 64.
Yeah. So, plenty of justification for the Federal Reserve, despite a strong headline number here today. Like when looked through, a stronger rearview mirror. The Fed's can easily justify its position on cutting interest rates. What about the future outlook for interest rate policy from the Fed, Jose? What's your early take on that?
Yeah, so we're going to pull up the Fed funds curve here. So we have right now 24% odds of a cut in January. In March, that goes close to it. That essentially becomes a 50-50. And then in April, folks start pricing in lower rates. And the expectation for year end is still over 2 cuts, a little more than 2 cuts. So right now, the bottom end range of the Fed is at 350, and the implied rate by year end of 2026 of next year would be roughly 2.95 or so off the top of my head.
Yeah.
A little more than 2 cuts next year, despite the dots saying only 1. I think that the contentious Fed chair nomination process, that's informing stronger rate cut odds, as well as the fact that labor market statistics, continue to worry some analysts, despite that some other ones are coming in strong. But that's really been the whole year. It's been a mixed bag of information. So today, ADP came in with a reacceleration, but BLS's numbers overall, October was really bad, and that's really why the October weakness is really overwhelming some of the modest performance in November. It wasn't a good performance because from a sector perspective, it was weak, but it's offsetting some of that. Folks on Wall Street, let's not really worry too much about the now pre-market equities are now starting to decline. Now they're back to the flat line. So we had strong gains in the pre-market heading into the number, and now we're starting to flatline. So now Wall Street is worrying a little bit about a slowdown concern, and is the Fed too late? 2 years reflecting that, going down faster than the 10-year in a bull steepening motion. Retail sales came in weaker than expected, 0% month over month. That means that the goods purchased were less than the month prior because you had inflation during that time period. So adjusted for inflation, it would have been negative.
That's the October report, right?
Yes, that is the October report on retail sales. U6 unemployment went up from 8% to 8.7%. Wage pressures softened quite a bit, down to 3.5% year over year. So one thing that's been helping the consumer has been wage pressures running ahead of inflation. Well, now we're seeing that gap is beginning to narrow quite significantly, with average hourly earnings at 3.5% and the CPI at roughly 2.9%, 3%. We'll see on Thursday. So that means that real wage gains are only running at around 0.5%.
Overall, Jose, I get it kind of feels somewhat heavy and disappointed that the economy is not really heading in the right direction at this stage, is it? Is that a fair assessment?
I think that the labor market, has a lot of issues right now, and the two prime concerns are immigration restriction. You can't get the non-farm payroll number that high if you don't have the labor supply. And the reality is that with the closed border, we don't have the amount of workers necessary to boost that headline higher. And then the AI adoption has also led to firms trying to automate more processes and do more work with less employees. Also throw on the labor market mismatch, the fact that a lot of the workers out there that are looking for employment aren't necessarily they don't possess the skills that employers need at the moment. So you still have that mismatch, and that's part of the reason why the labor market has just been so weak all year. And then think about the theme on Wall Street, Andrew, that's really been driving multiples higher and earnings north, as well as capital expenditure projects. It's all been about AI and this modern technology and its strong capabilities. So is the market becoming less labor intensive? That could be a long thematic paper that I write in the next few months.
Very interesting. Yeah, just feel a little bit nonplussed by today's data, I'm afraid, Jose. Very interesting.
You want to go to Chief Strategist real quick so he can explain forecast trader to our audience?
Certainly.
All right, folks, we're gone for a break. We'll be right back.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on Forecast Trader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investment.
And we're back.
It would be very interesting.
Some questions.
Yes, sorry. Let's let me bring back up those questions, and we can go through those. What was the most encouraging signal in this jobs report? This is from Russ.
The most encouraging signal in this job report is that the construction sector added jobs in November, and that's a rate sensitive area. So if the economy is slowing and rate cuts are being enacted, then it would be a positive if these rate sensitive areas are offsetting some of the weaknesses elsewhere. So that was a good development for construction to add 28,000 in November. But outside of that, Russ, I got to tell you, pretty bad report today. And I think that's why markets are giving up their strong, robust pre-market gains.
Which part of the report best supports a soft landing view?
What best supports a soft landing in this report is that job losses aren't precipitous across sectors. So it looks like there's modest labor trimming going on overall. Doesn't seem like the moves lower are that significant. Like we were talking about earlier, the 3-month moving average is at around 20,000 or so. So I think that supports a soft landing, because if we do get one or two really bad reports and the Fed, let's say they cut a 50 or they cut by 75, then all of a sudden we could get a fierce recovery in the labor market like we did back in September of 2024. We had that summer where job growth dropped below 100,000 for 3 months in a row. The Fed cut by 50, and then job growth came roaring back. The numbers are different now, though. 100,000 back then is like 50,000 now. So just because of the factors that I explained earlier, immigration, AI adoption, rate sensitivity, et cetera. So that's sort of, I think that's those areas, those concepts point to, are conducive to a soft landing.
Has the not consumer, but has the employee got the upper hand in wages here? With the border policy, the lack of skills for the appropriate job and so on. Are people able to get higher wages? Ross also asks, where are you seeing wage growth normalize in a healthy way?
So let me get to the first part of the question first. I think it's absolutely a time for folks that are dynamic, that are willing to be open-minded and willing to work extremely hard. I think that they can find tons of opportunity in this labor market because you have huge gaps, and the law of economics rewards folks that come in and fill in those gaps. So you have significant gaps, particularly in a lot of the areas that are in the previous administration were more dominated by immigrants, like agriculture, like construction, like leisure and hospitality. So, entering those gaps and finding a way to benefit disproportionately, those opportunities are there. Let's get to the second part of the question.
When are you seeing wage growth normalize in a healthy way?
Wage growth is not necessarily normalized. It is normalizing and softening. I would have preferred for it to remain hotter, just given the fact that inflation has been sticky. I would have preferred wage pressures to be sticky, but the gap between wage pressures and inflation, that's narrowing, that's compressing, and that's negative for consumer spending. And
Mm.
part of that is why retail sales in October was a negative report, because you don't have those wage pressures running well ahead of inflation. But the job openings situation, we got the JOLTS numbers. Those numbers have been pretty strong, albeit the Indeed numbers have sort of countered the strength from JOLTS. But I think that labor markets are slowing, and that directly points to a slowdown in consumer spending. So we really need strong effects from monetary policy easing as well as fiscal policy implementation to really get us out of this softness and get a reacceleration going next year.
Final question here. Please do send any further questions. Direct them to us on X. What would a good next jobs report look like for markets and households?
I would love 70,000 with strong sector performance across categories. So, like today's report, we only had 3 sectors at above 10,000 workers. That's not a good report. We
Mm.
had 8 sectors roughly that lost employees. So if we get some broad participation where all sectors are adding employees, that would be indicative of a broader economy with increased participation that is buoyant. But right now it looks like, things are softening at the margins.
Yeah. It's an interesting picture. It's kind of a relief in the sense that, for something that we didn't know, that we're just learning about in the rearview mirror, we've rebounded from big job losses in October. But at the end of the day, it's somewhat disappointing. The biggest sector gaining today was what, healthcare, Jose?
Yes, private education and healthcare.
Yeah. So 4.6% unemployment rate is the takeaway. That's not a good look.
Here's a 3-month net change, by the way, Andrew. This is a 3-month net change, and it just tells you that really the construction is benefiting from the rates coming down and mortgage spreads narrowing, but manufacturing is down, 19,000 over that 3-month perspective. And really all your performance is coming from private education and health services. Without this non-cyclical area, you're going into job losses essentially every single month.
Right. Not a healthy picture. Maybe that's why Stephen Moran, sitting in on the Fed, is arguing for a 50 basis point reduction. But that kind of doesn't seem. It doesn't seem a good reason that you're. That you don't trust government policy, therefore you need lower interest rates. I don't know. It just doesn't sound a healthy economy to me.
Yeah, it's the labor market for sure is weakening. Consumers are staying strong, but there's a lot of evidence out there signaling that household spending is being supported by the capital markets, and which has really been driven by AI capital expenditures. So is really that AI capital expenditures is extending the expansion that maybe should have ended 3 to 6 months ago. There's also evidence out there pointing to the wealthiest segments of the population carrying the highest share of consumer spending. So that gap has been widening significantly, while the middle income cohorts and the lower income cohorts have been paring back on discretionary activities. So A lot to watch. Let's see what happens next year. Hopefully, we get a rebound in the labor market early in January, and that can persist throughout the year. But like I said earlier, numbers north of 100,000 are going to be difficult to come by. Figures of 50,000, 60,000 will be considered good. And we'll probably get some more negatives in the next few months, unfortunately.
Yeah. Okay, let's leave it there, Jose. I look forward to chatting with you same time over the Consumer Price Index report on Thursday morning.
Yes, folks, and we'll be on tomorrow in Espanol with Judith Casasampere at 8:15 a.m. Thank you, ladies and gentlemen, for joining us. Thank you to our team here at Interactive Brokers, Andrea Brown. She always wakes up early with us. She's helping us with the cameras, with the audios, with all the infrastructure. So we just want to give her a special thank you. And we will have an opportunity to tell you happy holidays and Merry Christmas again on Thursday. But why not tell you now, just in case you can't make it on Thursday? Happy holidays and Merry Christmas. And thanks so much, Andrew, for always joining me. And I'll see you all soon.
Very good. Thanks, everybody, and bye for now.